On today's Hashi, I'm discussing Fannie Mae's latest forecasts and adjustments to their last one. Warren Buffett, he's retiring, but he's back predicting housing shifts and the weekly unemployment report for the last 7 days. Today is Thursday, May 22, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Let me know in the live chat where you are tuning in from today. We all learn better together. Let's make connections there, as this is the only 24-hour look back on the housing market, on the housing economy, the economy that impacts it for all real estate professionals. Best way to support the channel here on YouTube is to subscribe to the channel. It's a free and simple way to support what we're doing at BAM. Hit the notification bell if you want updates on the live hot sheets, and share this. Share the hot sheet. Somebody who might not know that it even exists, somebody that you care about in the industry. Could be a lender or an attorney, somebody who's in our industry, another agent who you want to help, and you want to have the same knowledge base that you're able to get right here, and make the connections that we're all making through that. I mean, so many people are making connections through this show, the hot sheet. I see it in yesterday when we did the webinar with Sheila and Chris that Jason just referenced. I see a lot of connections in the chat happening from right here, from all the work that we're putting in here on the hot sheet. We got a lot developing. All right. Fannie Mae put out their economic developments for May 2025. And with everything going on right now, I mean, like, obviously we've got the trade war stuff, but we have this stuff here. I mean, this just happened. This Trump tax bill clears the House now. It cleared it by, I mean, it cleared it as close as that Knicks-Pacers game last night. This was 215 to 214. You had every Democrat on the floor was a no. And then you had Republican representatives from Ohio and from Kentucky and from those two, I guess, Davidson and Massey. They were voting no. And then you had Andy Harris, who chairs the Freedom Caucus, voted present. So it came out to 215 to 214. By the way, the market doesn't love this bill, okay? And I'll jump into the market. I don't love any bill that continues to increase a deficit. Now, there was a bunch of last-minute amendments to this one, so I'm not an expert on this 1,000-page bill. Probably all the people who voted on it, I'd imagine 99% of them on both sides of the aisle are not experts on the bill. That's where you get a little, it's like, man, does anybody know what the hell's going on? I think the simplest thing to do here would be to cut the deficit, because the market doesn't like the debt that America is building up. Okay, it's why the 10 years at 4.595. I mean, look at this. We're at the worst spot in 3 months on the 10-year. It was up over 4.6 earlier today. We're almost at the high mark for the last 6 months. Market hates what's going on. Oh, you guys said you were coming in. You were going to doge this thing and cut out expenses, and you're not, or you're not cutting the deficit down. You're spending in other areas. To me, this is a recipe for higher for longer. There's some theories out there that even if the Fed cut, the 10-year would keep going up, which would keep pushing the 30-year up. So we got that going on. We also have this going on. This was really interesting yesterday. FHFA put this tweet out, basically taking President Trump's Truth Social and then putting it out on Twitter. Serious consideration to now Fannie Mae and Freddie Mac going public. Okay. Listen, the market has this priced in. If you look at Fannie and Freddie stock, we've done it in the past. I mean, since election day, it's up hundreds of percent. The market believes this is going private. But with everything going on, I mean, the market doesn't love where we're at. You're at 7.08, 7.08 on the 30-year fixed. The administration said, we're not going private if it means rates go up. I mean, show me a path going private where rates go down, be fully behind it. Okay. I'm not saying I want it in conservatorship forever, but there's too much pressure right now on rates going up. So my assumption when Fannie Mae rolled out May 2025 economic developments, the economic forecast table, the housing forecast table, both of which I've uploaded into, or actually I didn't do it. I think Vanessa did it from the BAM team, but are available for you right now in your hot sheet classroom on BAMX. So you can grab these and use these in your own, communications to your database. But I'm expecting, hey, both of these tables, the numbers are going to be worse. This is the forecast out. Okay. I'm expecting that these will, have been revised, meaning mortgage rates and transactions, and it won't be all that good for us. To my surprise, Fannie Mae has revised these and the information has gotten better. I almost don't believe my eyes, okay, with everything that's going on. All right, so GDP, they have revised for a 0.7% growth outlook for 2025 and 2026 is 0.7 and 2%. That's up from 0.5 and 1.9. Now, 0.7% growth it's meager, to be polite. If I'm using my normal language, it's pathetic. 0.7% growth on GDP, pathetic. Now, there's not that government hiring that was going on last year to inflate that number. So 0.7. I mean, I think if you get to a place where you have GDP growth of 0.7 in 25 and 2 in 26, probably looking at a shaky midterm for the status quo. CPI, they expect to rise 3.5%, unchanged from April. So they're in the same spot they were on CPI. Here's where it gets interesting. They've got mortgage rates to end 2025 at 6.1. We're at 7.1. We'll take that. A full point between now and the end of the year, that's 7 months. That's like losing a quarter point every 6 weeks, every 2 months, something like that. Moving a quarter point every 6 weeks. We'll all take that. Let's go. 5.8% for 2026 to end the year. Now, the big takeaway for me is they had it at 6.2. If I was going to bet, if I was going to bet some Bitcoin, which is at 111,000 a coin right now, unbelievable run with all the turmoil that's going on here. If I were to bet some Bitcoin, I would have bet it to go up. I would have said, May report 6.2 is going up to 6.3, 6.4. I mean, I don't know, maybe 6.5. I mean, heck, if you told me right now you could have 6.5 in the second half of the year on the 30-year fixed, I'll take it. I mean, we're up over 7. So they moved it down from 6.2 and from 6. And these are considerable move downs given where we're at. Home sales outlook, they revised to 4.92 million. And that's up from 4.86. So they're seeing more strength in demand. All these mortgage application reports that we're getting, right? Like I see Darth Vader on X yesterday talking about what we talked about yesterday. Mortgage applications down 5% for the week, but didn't say the next line up big year over year, right? We keep seeing year over year increases on mortgage application. Future looks bright there on demand. And if rates move down, you're going to see that number move up. Private mortgage originations to rise 1.99 trillion to 2.38 trillion for 25 and 26. And that's up slightly from where they were. So they see more financing in the future, not less. And I mean, listen, maybe, the last couple weeks, I don't know. I mean, you would figure April, this is their May forecast. So they had all the tariff drama. Maybe they did this early April or something. And, they thought the tariffs would push the 10-year down, which they didn't. And now this budget deal that, the spending bill, that's not pushing the 10-year down. Remember, the administration said they want to get the 10-year down. They're not doing a good job of it right now, just based on where we're at. I get it. You can't be reactionary in a 24-hour period. And maybe I'm a little reactionary today, as I don't like the rates up over 7%. I'm not saying, go ahead and make poor long-term decisions to, appease a market in the short term. But what I am saying is, man, it's hard to see with the lack of both sides of the aisle having a commitment to reducing the deficit. It's hard for me to see how the 10-year moves down. Well, I mean, why do you want to invest in America long-term when we're carrying so much debt? They got to carry it. It's not that attractive. All right, here's the economic forecast. We'll move to the housing table, both available for you inside of school for BAMX members. GDP, the overall look is, again, 1.7 for quarter two. So that's up from the -3 in quarter one, -0.3, 0.4 in quarter three, and 0.8 in quarter four. So on the whole, not great. 26 numbers per quarter get a little bit stronger, 1.62, 2.2, and 2.3. So you got a 0.7 for 25 overall and a 2 in 26. Remember, 24 was 2.5, stimulated by a lot of government hiring. PCE, that's the Fed's favorite inflation measure, is coming in at 1.7 for next quarter, 0.6 and 1.2. So 1.3 for personal consumption. I'm sorry, this is personal consumption expenditures coming in at 1.3 and then 1.7. So those are pretty good numbers. And if we go down to CPI, we looked at PCI. Let's go to PCE chain price index. That's going to be the inflation one that the Fed likes. They got it at 3.5 in 25 and 2.4 in 2026. So you don't have Fed target here in either of the remaining of this year or 26 per the Fannie Mae forecast on the PCE price index. Okay, so that's the number I was looking for, which is here, PCE price index. All right, let's move over to the housing table and just kind of break down the rest of where Fannie Mae is as of right now. May, these change. I like looking at this one because it changes and they forecast their models out. So housing starts for the year 1.33 million, 1.355 for 2026. That's down from 2024 numbers in both of those years. Single family, they have it at 900, under a million, 959,000 in both years. For single family housing starts, it's down from being over a million in 2024. Total home sales, again, up to 4.9 million for 25, 5.25 million in 2026 for total home sales. Now, when you go to existing, you have the 4.238 number there for this year, and then you have 4.5 million in 2026, over 4.5 million on existing home sale. The real estate professional wants to see that number move up, and 4.5 next year be a lot healthier place than where we've been here the last couple of years. When you look at the 30-year fixed, they've got us again ending this year at 6.1, coming out to 6.4 average. For the 6.4 average for 2025, like if you ended at 6.1 in December, but December it dropped a point, it's like, okay, well, we were at 7 basically all year. The 6.4 average for 2025 is like, we're going to get moving down here soon. There are no signs of that in the last couple of weeks, but that's what they're projecting. 2026 average is 5.9. So they're saying next year, 2026, we're going to be under 6% on the 30-year fix for the entirety of the year. Fannie Mae, I hope your May report comes in accurate. We'll see where they're at on June, or I hope that it's as close to accurate as it can get. All right. Warren Buffett announced his retirement. He'll be just moving over to the board, retiring as CEO, Berkshire Hathaway, the end of this year, I believe. And so, you would think he's winding down and maybe not, putting out reports on things like real estate, which obviously he's invested in, but that's Berkshire Hathaway Home Services is like it's throwing a piece of sand into the ocean. It is not a big component of what Berkshire Hathaway does, but he put out a report on real estate. He's one of the most brilliant people in the country, and when it comes to investing, he's right there with basically nobody else. So we want to pay attention to what Buffett's putting out there. And we've got it all broken down for you inside of the Hot Sheet show notes. It's uploaded into school for the BAMX members. Let's go through it here. Okay. He's got some major shifts in the U.S. housing market. 59 million Americans right now, according to Buffett, are living in multi-generational households. Okay. That's a really sharp rise from 5.1 million in 2010. Break that down in your mind. 59 million Americans are living multi-generational. Okay. That's a 10x from 2010. That's beyond a 10x. Okay. It'd be 51 million if we 10x'd it. It's like an 11x since 2010 on multi-generational households. All right. 95% of those households, when they surveyed, they function smoothly. 65% are citing a financial necessity as the top reason for living together. Okay. 95%, hey, no problems. In-laws, parents, grandparents, hey, it's all good. Okay. We like it. Maybe families are getting closer together. Maybe there'll be less divorce moving forward with some of this data. That is 59 million. That's a big chunk of the population, let alone the 11x up from 2010. It was common back in the day, according to this Berkshire Hathaway and Warren Buffett report. Okay. You're talking 20th century, it was common, or declined in the 20th century. Pre-20th century, it was common. Okay. So post World War II economic boom, suburban expansion, and Medicare-enabled independence for older adults is kind of when you started to see everybody get away from this. All right. By 1980, multi-generational households hit a low point. Only 12% of household formations in 1980 were multi-generational. Okay. 80s, people weren't doing this. 2010, only 5.1 million multi-generational households. People just weren't doing it. And now that number's up dramatically. Okay. So, here's something else that's interesting. In the 80s, when it was down, what'd you have in the 80s? You had high interest rates. Okay. So it hit a low point in the 80s and you had we're hitting high interest rates for, what we've been at here recently. And this number is hitting a high point. So it was hitting a low point in the 80s. You had high interest rates. We're hitting a high point with high interest rates, high prices. Okay. High prices, high interest rates. So the affordability factor is really impacting it. Who's living multi-generationally? All right. 55% of people surveyed already live in multi-generational households. 61% Gen X. That's 44 to 59. 59% of Gen Z, 18 to 25. You'd expect that. Millennials, 56%, 26 to 43. And then boomers, 33%, 60 to 78. Top motivations, financials coming in at 65%, closer to family ties 39, shared responsibilities 28. It's funny, I was just at this cocktail thing, the shared responsibilities thing. I was at this cocktail event down here in Naples, and I didn't have any cocktails, but everybody else was having cocktails. So they're talking about their summers and all the fun they're going to have. And it was parents from the school that my kids go to. So one of the people I met, she's telling me, hey, we're going to Greece for the summer. We're going to Greece for July. And it's like a vacation community. It's like built in for a community. There's 40 families that are going to be in one place. They all send their kids to the school. I think it's great, the school component of it. But I was like, man, you're kind of like in a community with 40 people. Everybody's got the same plan and shared responsibilities. Kind of creepy for me. I don't want to make friends, not that many friends. They've got a Slack channel going on for the, lead up to the summer so they can get to know each other and kind of share in that communal environment. That's for some people, not for me. 28% of people's top motivation for multi-generational living is shared responsibility. Among those considering it, 75% want to pool finances, 53% need to care for their loved ones. And anyways, there's some of the breakdowns. I've got the whole report that, we pulled. The report's long. We pulled out the top data points. If you want to use any of this, if you have multi-generational, kind of a community in where you're working, you want to pull some of this data, I've got that all uploaded for you. Let's get to unemployment. I mean, really, we're down to this. We are down to this if we're looking for the 10-year and the 30-year to move down. I mean, look at this. As we've been talking, the 10 years back up to 4.605. Market hates the deficit. I know, I get it. People don't want change. They want to keep spending. These politicians are addicted to it. The market's telling you, okay, you're just going to have really high rates because if you want me to hold your debt, it's riskier now. I mean, you're borrowing money to pay interest, America. Stop it. Yeah, it's going to be a high rate. It's very risky. So we're down to unemployment right now. And I'm not rooting for unemployment. I'm not rooting for a recession. I'm not rooting for any of that. But if we want this 10-year to move down, it's not moving down. The Fed's not making their moves down. And these rates aren't going to come down without employment moving off of these lows of the unemployment, rather, moving off of these lows. And this week's data doesn't help. 227,000 on initial claims. It's actually a decrease of 2,000 from the previous week. The 4-week moving average is in line. It's 231,500. So you can see unemployment's kind of just moving sideways, and that's good for for the economy. It creates strong hard data. But in terms of getting these rates down, you're not going to see that from unemployment. All right. Unemployment numbers, again, coming in strong. There's a lot of fear out there that these numbers are going to start going up, and it's just not happening. Okay. Highest insured unemployment rates by state: Jersey, Cali, Washington, Rhode Island, DC, not a state, Illinois, Nevada, New York, Oregon, and Puerto Rico. Also not a state to my knowledge, but there's your top 10. So I guess 8 of the states, 2 of the territories in DC and Puerto Rico. Those are the highest insured unemployment rates by state. Here's your initial claims: Mass, Virginia, Pennsylvania, Illinois, Nebraska. All states to my knowledge. Those are the largest increases. States with the largest decreases: Michigan, Cali, Ohio, New York, New Hampshire. Okay. There's your unemployment. There's your hot sheet for the week. Wrapping up this week. Wrapping it up here with a 7.08 on the 30-year fixed. With any luck, we got to get lucky almost with the 4 points. I think this goes up. Any luck, though, maybe something happens later today and we can move this down heading into a holiday weekend. It's Memorial Day weekend. You're not going to have a reading, obviously, Saturday, Sunday, but you're not going to have a reading on Monday either. for the 30-year fix. So where this thing gets locked in tomorrow on Friday is going to be the weekend rate. I mean, this could get it 7 1/8, could get into 7 1/4 range. I don't know how high this might go today. I mean, we saw, earlier in the week, it was just kind of trying to hold at 699, and it broke through yesterday. And so, we'll see where it goes here going into the weekend, but buyers locking in before the weekend, they're going to be up over 7%. More likely than not. So 7.08 on the 30-year fix. Memorial Day weekend, so there will not be a hot sheet on Monday. Markets will be closed. Stock market will be closed. And we'll come back on Tuesday. We'll have a new Knowledge Brokers pod on a separate YouTube channel, Knowledge Brokers pod over on Knowledge Brokers, going up tomorrow. So check that out heading into the long weekend or over the weekend if you'd like. And if you haven't done so already, join the BAMX community for support throughout every day and every single week in your real estate business. Every week we drop new content, social templates, blogs, and video scripts, as well as newsletters for you. This is just last week's data. Okay. Last week's social templates and content. That was just last week. Every week we drop new data for you, including all of the hot sheet data for you. Each and every single day from the hot sheet, we drop all of the content in here for you to grab each and every single day, all in school for BAMX members. Go to school.com/BAMX. Links down below so you can get into that. All right, guys, have a great Thursday. We'll see it walk through on the channel later. Knowledge Brokers tomorrow, back for hot sheet on Tuesday. We'll see you then. Until then, toodaloo.